Hello and welcome to episode 6 of our tax update series. I'm your host, Andy Rainford, Chartered Tax Advisor and Editor at Tax Essentials for Advisors. This week's episode has a reminder about payments on account, some good news for employers with workplace pensions, and a really important case on jointly held property. Up first, it's payment on account month. The second payment for 2024-25 is due at the end of July. As the tax year has already ended, you may be able to review some clients' income and, where appropriate, claim to reduce the payments for the year to help with cash flow. Do remember that if the payments are reduced too much, such that there is a balancing payment in January, interest will be charged on the difference, as the current rate is 8.25%. A cautious approach is recommended. Next, a warning to individuals working for umbrella companies. Spotlight 71 highlights some warning signs workers should be aware of that might indicate that they are unwittingly involved in a tax avoidance arrangement. These include being paid by a different company to the one the contract is with, or being moved from one company to another with little or no warning. It's always worth being wary of promises made by rogue companies, usually taking the form of sign with us and keep 95% of your income, or similar. Remember that if it sounds too good to be true, it probably isn't true. HMRC continues to move towards electronic communications being the default. It has recently confirmed that a number of non-statutory corporation tax letters will no longer be sent by post. The list is shown here for you. Additionally, it will trial removing the CT208 reminder letter with a small test population. If successful, that will be phased out in the future. Some good news for employers. In the past, it has not been possible to deduct input tax on certain costs relating to pension funds. The approach was to allow a deduction for admin costs, but not for costs relating to management of assets. From the 18th of June, all input tax on such costs is deductible. A small change, but a welcome one for employers, after the recent national insurance hikes they have been hit with. On to cases, and just the one this week, but it's a really important one. Alison Moss, who we'll call M, owned a property jointly with her husband F. A joint loan was taken out to purchase solar panels for the property. Shortly afterward, F went abroad on business. He executed a power of attorney in M's favor. The marriage broke down, but for whatever reason was not ended. To help with cash problems, M started to let the property but didn't report the income. When HMRC looked into her income sources, it raised discovery assessments of almost £11,000. M appealed, saying that F should be assessed for half of the tax, because the property was jointly held. At first, I thought this was a bit cheeky, but actually the income was used to make payments on the joint loan. So M had a valid point that F had benefited indirectly. Unfortunately for her, the rule in Section 836 of the Income Tax Act 2007 doesn't apply where a couple aren't living together, even if they are married or are in a civil partnership. The judge expressed sympathy for M's situation, but there was no ambiguity in the legislation. Okay, that's it for this week. I hope you found that useful and informative. Just a quick reminder that we have our next live webinar coming up on the 24th of July at 1 p.m. We'll be looking at the new rules for non-UK domiciled clients. I'll have a registration link for you on the next update. Until then, from me and the team at Tax Essentials for Advisors, it's bye for now.